All right, so why don't we kick off? So first webinar of the new year. So I'll spend a couple seconds just introducing myself in this webinar series because I know we have some new people on here, but I'm Mark Lamonica. I look after the individual investor business for Morningstar here in Australia. As you can see, we do have a podcast that you can certainly listen to. You can follow us on Instagram. And we also do these webinars. So we, this year, are going to take a little bit of a different approach. So we will do a webinar every Tuesday at this time. Once a month, we'll do one on Tuesday evening as well. All of these are recorded, so you can access those recordings on YouTube. You can also reach out to me, and I'll say my email address a couple times during this, but it's on the invites, mark.lamonica1@morningstar.com. If you have any questions about anything. Next, we do need to do, and for people that have gone to these things before, we do have a general advice warning to go through. So anything you hear today will be general advice. I obviously don't know anything about you, so I can't offer personal advice. If you're over in New Zealand and you want to get a copy of our FAP, you can get that from our website, morningstar.com.au, and the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. So all of that being said, what I think is great about these is it is an opportunity for interaction. If you have a question, somebody else probably has that question as well. So there are opportunities to ask questions or go into the chat function. So today we're going to talk a little bit about resolution. So obviously it is the resolution time of year. If you're like me and you go to the gym, you probably notice your gym is full. Lots of people like to start off the year with resolutions. A lot of them are about working out, but a lot of them are about money as well. So we're going to talk a little bit about money and a couple interesting stats that I looked up last night. So 25% of New Year's resolutions fail within a week of starting them, which seems strange that you can't last a week. But anyway, 25% fail, 43%, an additional 43% are done before Feb, and only 9% of people actually succeed with those resolutions. So we're going to talk a little bit about structuring financial and investing resolutions so that hopefully you can have some success and be part of that 9%, or maybe get that 9% up a little bit. And obviously as humans, change is very difficult for us. So we struggle when we are actually trying to change parts of our lives. We fall into routines and patterns. And what's really important for any sort of change that you're making, of course, is having a framework around it and a structure. And that's what's going to allow you to continue to keep it up. And, you know, investing is very much the same way. And for people that have attended other webinars in the past or podcasts or anything else we talk a lot about having a framework around investing. So like anything else that you are doing, there's a lot of different emotions that come into play with investing. Those emotions, of course, are based on market volatility, so market movements, right? So we have, you know, simplistically that Ben Graham talked about, we have, of course, greed when markets are going up, when your neighbor keeps telling you about how rich they are getting off of Bitcoin. And that's really what we experienced after sort of that 2020 COVID drop, that there was a lot of greed, and greed, of course, induces us to do things we wouldn't normally do. Generally, we're doing that at the wrong time in the market. And then, of course, what we saw last year, not as much in Australia, thankfully, but what we saw last year is, of course, the other side of the coin, the fear, right? The fear that markets are going down. And in both situations, people can rationalize their decision making. So whether that decision making is going all into the market at the top, whether it's moving more money into more aggressive assets at the top of a bubble, or conversely, rationalizing why you would sell when markets have fallen. I'll just wait until things get a little more comfortable and better. We can rationalize those, but that's still being driven by those emotions. We want to try to remove those emotions from investing. So once again, a framework and structure is really important to keep you motivated to hit those resolutions you may have, and then also to govern your decision-making when you're getting all of those emotional signals from markets. So the point of this is that, you know, the setup and that structure and framework that we're going to talk about today, which is so important to keep a resolution, is also really, really important to become a better investor. So it fits in very well. All right. So we've got this saying that I say all the time. We've got this saying at Morningstar that we are about the investor and not the investment. And if you don't really think about that, it seems, I don't know, a little bit superficial. But at the end of the day, they're two very different things. We have an investment industry that is product focused, right? So if you are an ETF provider, what are you pushing? New products. You're creating new ETFs. You're trying to push those out and get people to buy them. If you are a brokerage account, an online broker, what are you trying to do? You're trying to get people to trade more. So you're focused on different shares and the different shares you can be in. And this product-centric industry has really influenced a lot how investors think about investing. So it's all about what's the new ETF, or which ETF should I be in, what share should I be in? And those are ways to an end. But at the end of the day, what you care about is an outcome as an investor. So that's the difference between focusing on an investor and an investment. So what you want to do is you want to achieve a certain goal. And the problem with a lot of resolutions is they are not tied to anything. So they're really just a short-term set of activities. And you kind of, at the end of the day, without criticizing any resolutions people may have, there is a laziness factor and an ignorance factor built into them. And the reason for that is the laziness is because a lot of people don't think about what they want to actually achieve. So you'll hear a lot of resolutions around money saying, I want to save more in 2023. And that's fine, but that's not tied to what you're actually trying to accomplish. Nobody actually wants to just save money for the sake of saving money, right? It's no fun. It's delayed gratification. It is sacrificing something that you could go out and immediately consume. But we want to save money because we want to create a better future for ourselves. And that delayed gratification of taking money and investing it for the future, something you want to accomplish for the future, well, that's something that is that's something really important. But a lot of people are ignorant in any sort of defined way of what they want to achieve. And so having a goal like, I'm going to have a great retirement, I'm going to buy a house someday, whatever goal you may have, you need to be very, very specific about what that is. So we get all these articles, right? In January and December as well, is all of these different articles that we all go out there and consume in the hope that this new year will represent something better for us. So I made a couple things up, but you see these all the time. So, all these hacks to save more money, assessments of where the market is the share market risky right now? What's the best approach you should take for 2023? But really, and we'll go through what this framework is, really, if you start thinking about what you're trying to accomplish, we should be asking ourselves questions before we go out there and try to come up with a resolution and try to actually follow us. So what are those questions that we need to ask ourselves? Well, the first one is, how much do I need to achieve my goal? So it's not good enough to sit there and say that I want to have a great retirement. You need to figure out, what does that actually mean? We've done a bunch of these webinars around estimating how much you need to retire and the process to go through that. If anyone's interested in those, and we have a bunch of articles on them as well. If anyone's interested, just send an email to me and I can send out a copy of that to you. But we're not going to go through the process today, that full process, but it's actually taking the time to sit there and figure it out. The next thing, risky. The share market is risky right now. So what does that mean? What are they talking about there? Well, they're talking about, and when we talk about risk as investors, we're talking about volatility. So that's a definition of risk with investing. So basically, how much a portfolio can bounce around. So when we're talking about high risk investments, we're talking about investments that are very volatile. So they could go up a lot, but they could also go down a lot. At the complete other end of the spectrum, when we talk about very low risk investments, we could look at something like cash. So cash has no volatility if you put it in the bank. That's a very low risk investment. But that's how we approach risk with investing. But we're very different as investors, because the risks we want to focus on is we want to focus on the risks to achieve your goals. So let's use a couple of examples here, why this is different. Let's use that cash example, because now is a really good time to talk about it. So if I want a really non-risky investment, as I said, I can put it into the bank, right? I know tomorrow, the next day, everything else, that my cash will be in the bank. Government has a guarantee on it. The banks are highly regulated. There's all sorts of reasons why that cash isn't going anywhere. But if my goal is to have a great retirement, which I have defined, leaving all my money in cash is a huge risk because I will never achieve that retirement. Because, of course, we know about inflation. We know that we get very low interest rates on cash traditionally. Right now, we're seeing a huge gap between the level of inflation and cash. So you're actually losing money in real terms, inflation-adjusted terms, by having your money sitting in the bank account. So that's an example of, okay, well, the risk that the investment industry talks about is not the risk I'm facing. The risk I'm facing is trying to get returns in order to achieve my goal. Now, the more volatile an asset class is, so the more something bounces around in price, the higher risk is considered, but you're compensated for that by having higher long-term returns. So the real risk to me, as an investor that has a while until retirement, for example, or any goal that you have, if there is a long time period before that, the risk to me is not that the market goes down 20% this year, because I'm not retiring next year. The risk to me is that over the next 20 years, I don't get the level of returns that I need to achieve my goals. So it's a reframing of this risk conversation. And remember that when you read articles and when you hear the industry talking about risk, just remember they're talking about volatility because they don't know you and they don't know anything about your personal situations. Figure out your own risks. What are the risks to the goals that you have defined? What are the risks to actually achieve them? That can put a lot of stuff into context, and we'll talk about that in a second. And then, of course, we have this best approach to investing in 2023. Well, two things about this. Number one, once again, if you have a very long time period, 2023 is not your only concern. So that's the other thing that I'd start about. But that's the other thing I would say. But I'd also want to say that once again, to look at the investment industry, we have a lot of advocates in the industry around certain approaches to investing, right? So we have value managers who say that value investing is the best way to invest. We have growth managers that say growth investing is the best way to invest. Someone who has a fund will tell you a fund is the vehicle you want to use, but an ETF provider will say an ETF is actually the vehicle. And then your brokerage account may say, go out and buy individual shares. Like those are all different approaches. And of course, there is a self-serving, even if they believe it, a self-serving aspect to that advocacy for a specific investing approach. But what we want to focus on is what's the best investing approach for you. So what's the best investing approach to achieve your goal? And once again, we're going to talk about this more today, but that can be very, very different than anything else. So we're all unique. We all have unique goals. We have all unique situations and financial situations and jobs and places we get money and everything else and costs that we have to deal with. So it's really coming up with the best investment approach for you. And the other thing that's really important that I don't think is recognized enough is temperament and building an intellectual connection with that investing approach. Because remember, what we don't want to do is we don't want to have the emotions of investing cause us to make poor decisions. And one way to resist that is have a strategy that you're very comfortable with and that intellectually you feel an attachment to. So you don't want to go buy Bitcoin because your neighbor bought it. You want to go buy Bitcoin because you believe in the long-term case for Bitcoin. Because if you just go with your neighbor's recommendation, it means what are you going to do when it's done, when it's dropped as much as it has? You're going to panic and sell, right? Whereas if you were a long-term believer in it, you probably wouldn't. So it's building that investment approach and strategy that's connected to you that's really, really important. And so the other thing, and obviously what we have at the bottom of the page is, you make a resolution. So focusing that resolution before getting into a resolution, focusing on what you're trying to accomplish is going to be that framework that's going to help you achieve what you would like to do. All right, so we're going to walk through some of these steps. And at the end, we'll kind of get to an area where we can talk about what should an actual resolution look like. We're going to start with goals. Now, for each one of these different approaches, we're just going to go over it very quickly. We have full webinars and guides and everything else. So once again, if there is a certain thing, whether it's goal setting, creating investment policy statement, all things we're going to talk about today, if there's something you want to learn more about, you can email me once again at mark.lamonica1@morningstar.com. All right, so let's start with goals. So I mentioned this earlier, but goals have to be very specific. So whether it's retirement, and retirement's a little bit different because there's a couple other steps that go into figuring out how much it costs, but any goal you are trying to accomplish, you need to estimate the cost of what that's going to be. And what we're doing here, by the way, for people who are more mathematically inclined, is we're basically building out a formula. I'll spend a couple minutes on it, but that's why each one of these inputs is so important. So how much will your goal cost? When do you want to achieve your goal? So you hear a lot, I want to retire early. Well, that's great. Let's figure out what early means. Does early mean 50? Does early mean 60? Does early mean 32? When? Figure out when that needs to happen. You need to have that information. How much have you saved for your goal? There's a shocking amount of people that don't know where any of their finances are and haven't checked their super and have 12 different supers. I assume that you're probably not in that boat since you're tuning into this. Figure out how much you've saved for your goal. You need to know your starting point. And then you need to estimate how much you can save for your goal in the future. And that's the input, of course, that we can manipulate based on potentially a resolution. But going through this process is going to allow you to calculate the return you need. Now, we're not going to spend too much time going into this, but very simply, this is a formula. All right. So if you know how much money you have today, you know how much you're going to save, you know how long you have to achieve your goal, and you know how much that goal costs, you can calculate the missing piece in there, which is what is your portfolio actually going to return? What return do you need? What is your target return? And this is not a topic for today, but that target return, that required rate of return, is a huge input into all the decisions around the investment strategy you're going to take, the asset allocation you're going to line up. So it's a really important number to get. Now, a lot of people are probably looking at this right now saying, how could I ever come up with this estimate? If I'm retiring in 20 years, how do I know where my life is going to go? I don't know. I could switch jobs. I could have more money, less money. All sorts of different things could happen. And yes, that is true. But as we have at the bottom, this saying, perfection is the enemy of progress. You can change all of this. But what this is going to do is it's going to allow you to put together a framework so that when you make a life decision that is going to alter your finances, you can figure out what that actual input is. Let's say that there's an opportunity to do something that you've always loved, but it pays less than your current job. Well, you can go in there and say, okay, I know how much I had planned to save. If I take this job on a reduced salary, I'm going to have to cut how much I save. What impact is that going to have on my goal for retirement? And you can actually quantify this, right? Okay, well, it means that either I retire with X amount less dollars, which will have an input on my lifestyle, means I have to work 5 years longer, but maybe you'd be willing to do that because it's a job that more aligns with your values and interests. But it allows you, of course, to make those natural pivots that happen in life. But just because this is an estimate doesn't mean that we shouldn't do this. It's a lot better approach than what most people take with trying to do anything, right? That they put their head in the sand, and of course have no idea what saving more, saving less, making those decisions, what inputs or what those changes in inputs will have on their ultimate goal, because most people don't actually have that goal defined. All right, so let's talk about risk. So the second thing that we talked in there, we have our first question up here. Oh, and very appropriately, it is from Lisa. So for people that have tuned in before, Lisa is we'll call you a super fan, Lisa. So Lisa says the dip in currently held bond values locks my self-managed super fund into a lower income unless I sell and take a loss, whether other investments can help balance that. Lisa, let's get back to your question. We'll hit that up at the end. It's a good question, but just to keep us rolling with what we're talking about. But if anyone else has questions, throw them in there. All right. So once again, we talked a little bit about risk, and I want to expand on that and expand upon how taking a different view of risk, a risk that is at odds with how we talk about investments, but taking a view of risk around actually achieving our goals, why this is important. And setting goals and having this framework allows us to focus on the risks that matter to us. So what we want to focus on as investors is we want to focus on risk capacity. So risk capacity, very simply, is how much risk do you need to take on in order to achieve your goal, which of course you now know because you've defined it. So why is risk capacity important? Because normally the way that we approach risk is we approach risk with a risk tolerance perspective, where someone goes, how much risk can you tolerate? How much volatility in your portfolio can you tolerate? So there's all sorts, I won't get on my soapbox about this, but there's all sorts of reasons why risk tolerance does not work. But very simply, it has nothing to do with actually achieving your goal. So framing risk around what does it take to achieve your goal, the return that you need to achieve your goal, allows us to understand that we need to focus on a portfolio with the right assets in it, in terms of asset classes and the expected long-term returns to get there. So a lot of people say the stock market, including my original example, the stock market is too risky. I'm going to keep my money in cash. And once again, that is fine. But if you need a 7% return over the next 20 years to be able to retire, well, then the risk of achieving your goal is you will not get your goal, right? So that's where we're focused on risk capacity. Risk capacity tells us we need a 7% return, and our actions can be based off of that, meaning that we need a portfolio with more shares and more growth assets as opposed to things like bonds and cash. And yeah, we've got kind of these three different examples, which I don't need to go into because they're on the screen, but yep, there's not stability in risk. So risk tolerance, people act like it is something that's a point in time assessment that applies to you for the rest of your life. That is not true. We interpret risk, especially investment risk, very poorly as humans. When the market goes up 10 years in a row, everyone will, of course, expect that to keep happening. But reality, that's actually leading to more of a likelihood that it's going to fall. Valuation levels are higher, et cetera. So yeah, we've got that. And the other thing is, of course, humans have a lot of difficulty assessing how you'll react in a stressful situation, right? So we like to think we know how we'll react, but people generally don't and have a very difficult time assessing that. All right, so that's risk. So once again, start hearing things. You're thinking about positioning your portfolio, especially for the year, and you start hearing things that the market's very risky right now. Here are all these problems that are happening. Just remember that what they're talking about is very different from what you should be thinking about, and that's the risk of achieving your goal. The risk to achieve your goal. All right, so next we're going to talk a little bit about strategy. We've got a good question from Murray. So Murray says, and this goes back, we'll go back a couple slides. So remember inflation. So, and I put this together actually before inflation started, but Murray says, okay, I remember inflation. What's your 20-year forecast for inflation and your degree of certainty? Should my goals be expressed as relative to inflation? Yeah, so I say a couple different things. Yes, you need to take inflation into account. So we have obviously gone through a pretty unprecedented period since kind of the mid to late 80s until last year, where we've had very low inflation. So I think it's something that really isn't on people's minds, just because a lot of people have not experienced it lately, other than, of course, last year. But inflation is obviously critical. You need to incorporate an inflation estimate into any sort of long-term goal that you have. Now, what I would say is, and to answer Murray's question, if you email me, I'll send you Morningstar's. I just don't remember it. We raised it recently. We do have a long-term inflation estimate. It's not on the top of my mind. But conceptually, what we need to think about is the difference between how inflation is measured by the government and our personal levels of inflation. Because what we care about is our personal levels of inflation. And that's not to say there's anything wrong with the way the governments measure it, but of course the way that government measures inflation is there's a basket of goods that's supposed to represent the quote unquote average Aussie. And then periodically they go and they look at what all that stuff costs, and that's your CPI that gets calculated. So the consumer price index, and that's a perfectly rational and normal and good way for government to measure inflation, but you are not the average Australian. And so what you really need to do is look at how inflation is going to impact you, especially if we're looking kind of long term and we're looking into retirement and the costs that retirement would be. And a perfect example of this is, there is, from a rent perspective right now, there is a lot of inflation. So we are seeing higher and higher rents. Of course, a lot of people holding variable rate mortgages are seeing their housing go up a lot, and that, of course, or their housing payments go up a lot. And that, of course, is reflected in CPI data. But if you are someone who owns your home outright, that's not something that applies to you. So there may be other things that apply to you. If you're very young and there's a lot of inflation going on around healthcare, well, because young people use healthcare less than old people, maybe that doesn't impact you as much. I don't own a car. So increases in petrol prices and car prices going up don't really affect me. Petrol, obviously, in certain ways, other things I pay for, but it's just an example why it's really important to look at your personal situation. So we will get that to you, Murray. We did increase it. The degree of certainty, I mean, listen, it's an estimate. It's a far out estimate into the future. So, I think that in my mind, and the way that I plan things is I look at a couple different scenarios. What is my retirement going to cost if my personal costs inflate 3% a year? What would it cost if it was 5% a year? I mean, I think it's very difficult. Everyone likes to make predictions, and lots of people at Morningstar make predictions, myself included. But I think we just have to be very careful about locking in one assumption about what's going to happen in the future. And I think kind of ranges help. But anyway, thank you, Murray. Yeah, if you email me, I'll get that. It's still in the twos. I know it's still in the twos, but it did go up, our estimate of long-term inflation. All right, so we're talking a little bit about strategy. And this is really the last part of this framework that we're trying to create to give us some perspective and context with some of these resolutions we're going to come up with. So, as I said before, what we want to do is we want to come up with the best approach and strategy for you for achieving your goals. And it's okay if somebody else takes a different approach. I think a lot of people, and we've been hearing about this a lot right now, a lot of people think that there is one best way to invest, and they keep chasing that best way to invest. So what was the best way to invest 2 years ago? Well, the best way to invest was large cap, so big companies, big tech companies in the US. What was the best country to invest in? Well, the past couple of years, it's been the US. And then all of a sudden, we get to this year and everyone is completely reassessed with what's happened last year, right? So now people are saying, well, value is really important, income's really important, and yeah, these tech companies are having problems. You want to rotate away from tech, and the US is having problems. You want to rotate away from the US. And the problem is that people taking this approach of just kind of chasing whatever has done well is a recipe for a disaster for investing. What you want, whether you're a growth investor, a value investor, an income investor, or anything else, what you want is a long-term strategy, knowing that some years your investing approach and your investing strategy is going to underperform. And that's life. There is nothing that outperforms every single year. What you're trying to do is create an approach and strategy that you can use for the long term, which means you need to have an intellectual alignment with it. It has to fit into the way that you view the world, has to fit into your own temperament. There's all sorts of reasons why it's really important to have something that is based on you. And of course, your goals and what you're trying to achieve. If some people might only need a 3% return in order to achieve their goals, maybe they've amassed a lot of money. Well, some people may need a 10% return. And so it doesn't make one right or wrong. It makes one right or wrong based on you. So how do we do this? Well, the way that we do this is we actually write it down. So one thing, and I guess this is a good resolution advice as well, is writing things down makes it more likely that you'll actually achieve them. And so how do we write down our investment approach and strategy? We write it down in an IPS. So what we're trying to do is we're trying to define what we're trying to accomplish. Of course, it comes in from the goals. This is an investment policy statement, by the way. It's what IPS stands for. Sorry for the jargon. It's going to be the policy that defines your approach to investing. So we've got our goals, what we're trying to achieve. Now we want to talk about, okay, what is the approach that we're going to take, and what are we going to, and how are we going to execute that? So, all right. So the IPS, you can read, but that's all that I've been talking about. We want to do this because it leads to accountability, and it also leads to being thoughtful and deliberate. So when I talked about in the beginning that people rationalize certain decisions that they make, well, if you have an IPS, if you have something you can go back to, it's a way to make sure that you're just not rationalizing away, or you're just rationalizing yourself into an emotional reaction from the market. So that's really important. And yeah, as I said, and I think this last point is actually really important. As I said, that if you are going out of your comfort zone, so my example, the person who decided to invest in Bitcoin because their neighbor told them to, if you're going outside of your comfort zone, it's often a function of greed. So personally, this is personally, I'm not saying anything, anyone else should do this. Personally, I would never invest in Bitcoin. So it just does not fit my approach and strategy. I want investments that generate income, and I wanted investments that generate income from large, stable companies that have low business risk. Bitcoin does not fit into any of that. So under no scenario would I invest in Bitcoin. It's easy for me to say that now that it has fallen so much, but I was saying the same thing when it was, 60,000 US dollars. So the reason for that is because I took the time to actually sit through and think about what kind of investor I am. And if you do that, that means when your neighbor comes over and talks about how he just bought a Ferrari off of his Bitcoin, then you can say, that's really great, I'm happy for you, but that's just not the approach that I take. And what that prevents is it prevents us from following all these fads and trends and following these newspaper articles that tell us what the market's going to do over the next 6 months. We don't care about that, right? We're long-term investors. We want to focus on the long term. So we've got another. So Bryce says anticipated returns for Aussie equities over the next 5 years. Anticipated return. Okay, well, let me show you, Bryce. We'll just do this live before we get into the resolution. So anyone who's done this before knows that I am not very good at finding things on my computer. But I will show all of you in a second how to find this on our website and also answer your question all at the very same time. So we can call this multitasking. But I've got to find the screen first, which is, I have a tendency to have a lot of things open on my computer, and this, of course, was the last. All right, so I am on our Morningstar Investor website. So where do you want to find our long-term returns? So we have more than 5 years. We've actually got 10 years on here. So I'm going to go into the section called Investment Policy Statements. So as I said, and I've been talking about this kind of generally, but you can create an investment policy statement as part of our product, Morningstar Investor. And as part of that, what you want to look at, and part of your investment policy statement should always include asset allocation, because asset allocation is very important. In fact, where you allocate your assets into different asset classes, individual securities, et cetera. There's all sorts of ways to slice it and dice it, but that will have a very big impact on the returns you achieve over the long term. So what it does is allows you to put in your target. We have certain asset allocation models based on what you want to achieve. If you're an aggressive portfolio, most of this is in growth, et cetera. But we also have this tab called expected returns. So the expected returns are the returns that we believe, our Morningstar Investment Management Group, are achievable for different asset classes over the next 20 years. And these are obviously per annum returns. Now, basically, you can go see through these different asset class breakdowns what we think the returns are. So let me talk a little bit about why, very simplistically, why Australian equity returns we see as being higher than international equity. And remember, when we look at international equity, we're talking 70% US. The US makes up about 70% of developed market capitalization. So we're talking primarily the US. Now, the US has done a lot better than markets like Australia. And so people can talk about their franking credits and everything else, but the US has significantly outperformed the Aussie market since the GFC. So, since that 2008, 2009 time period. Now, of course, extended outperformance leads to higher valuation levels. Higher valuation levels, of course, well, it's not of course, higher valuation levels lead to lower long-term returns. So, of course, the US, very high valuation level. Australia has not done as well in a very different market, very different companies in it. So that is why Australia, in our view, will have better returns from this point going forward than the US. Now, of course, this can change. If the US market drops 30% this year and the Aussie market stays the same, then of course, all of a sudden we're getting lower valuation levels, but that's investing, right? When you look at over the long term, those valuation levels of when you buy are really, really important to those future returns or those specific dollars over the long term. So I hope that helped and answered your question, Bryce. All right, going back to the PowerPoint. For me, that was a relatively good switch over. So maybe my New Year's resolution could be better at this. All right, so we talked about IPS. Let's get into some specific context-driven resolution. So I made the joke about, it wasn't very funny, but I made the joke about how gyms are very full right now. And as I said, a lot of resolutions people have are around healthier lifestyles, working out, losing weight, et cetera, and around money. Saving more, getting on top of your finances, et cetera. The interesting thing is there are a lot of similarities between the two things, right? That success in investing, just like success in trying to live a healthy lifestyle, is a result of a lot of very small decisions that you're making. Are you going to order the cheeseburger or the salad? And if you order the cheeseburger one day, it's not going to do anything over the long term, but it's the result of all those little decisions. It's the same thing about investing. Are you going to save and invest? Are you going to go out and spend your money on a trip to Bali? So it's all about these little decisions that you're making over the course of a lifetime that will result in where your outcome is. And as I said before, it's hard because all of this involves delayed gratification. Because it's not like not ordering the cheeseburger is going to make you lose 2 kilos sitting in the pub. But over time, hopefully that would help you lose weight. Same thing with investing. Whether you go to Bali, or I don't know how much it costs to go to Bali, or put that money in your account, maybe it'll make a big difference in your life, or maybe it won't. But really, what it's about is all those little decisions that you've made, all those little sacrifices you made over the years to save and invest instead of spend. They're going to make the difference going into retirement. So it's very hard to do that. And that's why having context around it and really understanding the impact of those decisions that you're making can help you have a resolution that you're actually going to achieve. So a lot of people will sit there, and I talked about that, like 12 life hacks to save money. And, I don't know. We see these all recycled. Every year, this stuff is recycled, whether it's don't go out for coffee, make it in your home, to call your mobile phone company and demand their lowest rate. You hear all this stuff all the time. But a lot of people approach New Year's resolutions like this. Okay, so I'm going to take this set of steps. I'm going to stop eating out for this week, or stop ordering delivery for this week, for this month, and I will save X amount of dollars because I'm cooking at home. And that's fine, right? But once again, the problem with all of this is when you work late and then you go home and you're walking home, you're like, I really don't want to go buy food and then cook it. I'd rather just order a burrito. It becomes harder to make that decision. But if we put some context around those decisions, so instead of focusing on this $500 a month that you're trying to save, I put $500 a month at a 7% return into, I believe I used 20 years. So I put that into our portfolio projection tool, and that's $250,000 extra at retirement. So all of a sudden, you can start thinking about what that $250,000 extra would mean to you. And what that means basically is that you could increase your spending by $10,000 per month. So I'm using the 4% rule there to translate that 250 into 10K. So all of a sudden, maybe that sacrifice that you're making that you don't want to do, going to Kohl's and picking up ingredients and making your dinner, thing you don't want to do after a long day, all of a sudden you can start imagining what you can spend that $10,000 on. So maybe that means, this is your thing, maybe that means an extra trip to Bali every year during your retirement. And maybe that is the motivating factor that gets you into actually keeping up with this resolution. So the only way you can do that, of course, is by knowing what you're trying to achieve in retirement, knowing the return you need, so you're able to calculate what that impact would be. We hear this all the time. So lots of people talk about, market feels risky. I read all these things. The market is risky. I'm just going to hold more cash. And then when the market's safer, I'll get back in. So obviously we could spend an entire hour talking about market timing, but that's just not going to work for you. But having context around, once again, what are the risks that impact you, is if you're making a resolution around looking at your portfolio and repositioning your portfolio, well, maybe you can sit there and say, okay, well, volatility is not the risk for my retirement because I've got more time. My risk is that if I miss out on returns, if I have lower long-term returns, I'm not actually going to achieve that. And of course, we do this by having that framework. And then, of course, I kept saying Bitcoin, but yeah, buy this ETF because lots of people think it'll go well. So lots of people think that this ETF will be great for God knows what reason. Your uncle told you, you read in the papers, on some blog or chat board. Well, what you need to do, of course, is think about what are those investments that make sense given your temperament, strategy, and intellectual approach to investing, as we talked about. And then you can sit there and evaluate that ETF within the context of your strategy. Because maybe that ETF that they're talking about is right for you. Maybe it fits everything that you're trying to do. Maybe it fits your objectives. Maybe it fits the criteria that you use to select investments. Maybe it is the right ETF, but putting it within the context for you is really important. All right. We went through all the slides, which is good. So we've got a couple of things. It's possible to receive a copy of the presentation slides. It is, you have to email me for them now, because I don't know your email address. So yeah, if you send me an email, I can send a copy of the slides. And once again, if people are looking for, on any of those topics, are looking for a longer explanation of them, I can send webinars and podcasts and everything else. So send me an email. So we're going to go back to Lisa's question, which I ignored. All right, so let me see if I understand this, Lisa. The dip in currently held bond values locks my SMSF into a lower income unless I sell and take a loss. What other investments could help balance this? So unfortunately, Lisa, this sounds a lot like tax advice, if I'm reading that correctly, which I, of course, can't give. But if I'm misinterpreting it, please let me know, and I will. I'll answer your question over email. So I'm putting. So we have a question saying, where do I send my email address? So I just put it into the chat. So basically, email me. and say, I would like a copy of this, and then I'll write you back and send it to you. All right, so we've got some questions from Eleanor. Says, holding cash because the equities are priced too high and I'm retired. I consider holding cash for preservation. The market drops and you buy, but you do miss out on doing this if it keeps going. Well, yeah, so listen, there's nothing wrong with holding cash. All I am saying is that it's really important to, I sent it to the wrong, sorry, I sent my email address to the wrong thing. All it's really important to do is it's important to figure out like, what is your approach? So yeah, holding cash, if you're in retirement, yeah, I don't consider that a problem as well, right? Not a problem at all, but it's based on your situation and what you're trying to, sorry, I'm putting my email address in again, what you're trying to achieve. So yeah, I mean, listen, I still think the market's high. I still hold a fair amount of cash. And the reason that I've done that is because I understand the return that I need to achieve my goals, because the market had a very big run up and I'm well ahead of the return that I needed to achieve my goals. And so I'm comfortable holding more cash because of that, because I'm actually ahead of pace in achieving my goals, even with what happened last year. So having that framework, once again, allows me to make a decision like that, where holding cash to me is something that allows me to take advantage of those future opportunities and something that will not prevent me from achieving my goal. So the problem, and sorry, I'll go on a little bit of a rant on this whole thing. The problem that a lot of us run into is the way that we run our portfolios is under a wealth maximization approach. And that basically, what that basically means is, you know, what is your goal for investing? My goal is to have as much money as possible. And that may be your outcome. And that may be the ultimate outcome that you're trying to achieve. But thinking about investing in that way leads to all sorts of problems. And really what it leads to is you are always going to try to find the best investment and the best investment for a short period of time. So these are all these people that like rotate and churn through individual investments and churn through different investment strategies, because they'll read some article where they've gone out and they've, you know, interviewed a fund manager, and the fund manager, of course, will be, let's say they go interview a value manager. The value manager will say, here is the 25 reasons why this is a fantastic time to be a value investor. This is why value will outperform. And of course, number one, they're talking up their own book. Because that's what they do. They're a value manager. But the other problem with this is if you're in that wealth maximization mindset, of course, you're going to try to shift your money into being a value investor, because you think that that's going to be the best investment. You always have to be in the best investment if you're taking this wealth maximization approach. But anyway, my 2 cents. I think coming up with a strategy that's based around you will work a lot better. And you will, you'll make better decisions. Oh, now we have all sorts of questions. So no more rants for me. I'll just try to get through these. So Andy says, if I was looking at my personal asset allocation, should I include my house, which I live in, or is it better to exclude? Thanks. Okay, housing is a really tricky one when we think about asset allocation. So what I would say to you is that if you were looking at, let's say, retirement, and retirement is your goal, and you're including, when you're looking at your asset allocation for the assets you've dedicated to retirement, you're including your house. Well, my question for you is, what would be your plan with your house in retirement? If your plan is to live in your house for the rest of your life, then I would not include it, because while it's great that it would go up in value, you somehow need to extract that value from your house, right? And there are ways to do that. So there's certainly ways to do that by borrowing money, but that's of course adding expense. So what I do is look at your own personal situation. But if you own a house in a very expensive part of the country, maybe a very expensive neighborhood in an expensive part of the country, and your plan is to sell that house when you hit retirement and move somewhere cheaper, remember, it has to be cheaper. You can't just sell your house, buy one that costs the same. If your plan is to sell that house and move somewhere cheaper, then yes, you could include a portion of that in your asset allocation, but just think about what you're trying to achieve there by including that house and sort of what the purpose is, right? When we look at asset allocation, we're really looking at it to try to make sure that we have the right mix of assets in order to hit a desired return level. And that's why it's so important to think about the house, whether it's an asset that you're going to use to pay for retirement or it's just something you're going to live in. And that appreciation is great. Your kids will thank you for it. But if you want to die in your house, then yeah, not something I would include. So Peter says risk tolerance is subjective. Easy to say moderate to high, but a loss is a loss. It can potentially destroy wealth creation. What do you think about the pitch test or only act after 2.5 days of thought? Yeah, absolutely, Peter. So two things that I would say that I 100% agree with is that what we want to do when we're making decisions is we want to be deliberate and thoughtful. And really, with a lot of the technology that has come out, the ability to make changes to your investment accounts, the barrier to do that has gotten lower and lower and lower. If we think years ago, what would I have to do in order to make a change to my investment account? I'd have to get on the phone, call a broker, talk to the broker. All that takes time. The broker could potentially push back and should push back if you're making a stupid decision. So there's all these sort of barriers. Now they've all changed in technology. I can walk down to lunch after this and trade on my phone. So the ability to do something quickly is not a good thing for investing. So I really love what Peter said. So the two things are, number one, find a mate, your partner, whoever. And before you make a change, go pitch that change to them. Explain to them the rationale about why you're making the change and why that's a good decision. And just going through that process, they don't even have to say anything at the end of the day. Going through that process of thinking through how you're going to pitch this to somebody is really, really beneficial because it can help make sure that that decision is more thoughtful and deliberate rather than just impulsive. The other thing is you can do this by putting in basically a delay mechanism. So if I decide that I'm going to sell this stock and go buy this stock, and I decide today, because I just decided it's a good idea, I'm not going to walk down to lunch and buy it. I'm going to say, okay, I'll do it early next week. And that gives me some time to run it through my head and start thinking, like, is it such a good idea to do? I'm going to have to pay taxes on it. I'm going to have to pay transaction fees. Like, is that a great decision? So Peter, I completely agree. Yeah, so Philip says, remembering there's no Hall of Fame for people who time the market correctly. What signals are you looking for when making a decision to reduce the over allocation of cash? Most of us long-term investors have. By the way, I retired at 54 using exactly the same approach you outlined. Okay, well, that is good. Thank you for that, Philip. Yeah, so listen, what we're trying to do is we are trying to make, and it's very hard, right? So for someone like me that has an over allocation to cash, and it's not just me. There are certainly a lot of people out there. We see that. Gemma Dale from NAB always gives great presentations talking about the behavior at NAB trade. And a lot of people are holding cash. What we want to do is we want to make this a valuation-driven approach. And I'll give a little bit of an example. And actually, I wrote an article on this on Philip because I made a purchase, something called American Tower. It's a U.S. Stock, and I sort of walked through why I decided that after years of not buying anything, why this was a good investment. And really what it was centered around is the return that I need and where that return is going to come from. So returns only come from three places with investments, right? Come from dividends. They come from changes in valuation level. So if valuation levels go up, you get that return if you own that asset. Somebody used to be willing to pay $10 for every dollar of earnings for that company you own. Now they're willing to pay 20. Well, that's good for you, right? It doubles. And it comes from changes in earnings growth. So those are the only three places it comes from. And it's obviously a combination for all of those, right? And they play off of each other. Earnings may be falling while valuations are falling, et cetera. But really, I take a look, I try to look at those individual investments and I say, okay, if I need 7% return, where is that going to come from? You know, and obviously it's easy to sit here now, but if you went out there and you bought Tesla, for example, at the beginning of last year, and it was trading at like whatever, 800 times earnings, doesn't pay a dividend, where's your return coming from? Right? So you know the valuation level over the next 10 years is not going up because it's not going to trade at the sky high valuation level. It's not going to pay a dividend. It's a very capital intensive business everyone forgets about. They have to build lots of big factories, do lots of stuff to build a car. So it better come from earnings growth because you know that valuation level is coming down. Earnings have to grow really, really quickly. What's the problem the company's running into now? Earnings are growing quickly, but not as much as everyone anticipated. And obviously their CEO is a lunatic, but that's really what we need to think about. So I try to judge individual investments on those merits. And I, of course, did not go all in on this one share, but as an example of something that I thought was a good opportunity for me. And so I put some money into the market. So what I try to do is judge each one of those investments when I'm doing this. Okay, so sorry, I talked too long on that one. So Damien said, ask about REITs. So I'm wanting to diversify. Is VAP a viable option, or is this traveling down the dreaded thematic ETF option? And is there a macro consideration I should think about now, like with bonds? Thanks. This is part of my goal to diversify. Okay, so a couple different things. I would not consider VAP a thematic ETF, right? It is getting exposure to a specific asset class or REIT, real estate investment trust. So yeah, I think that's very different than a theme. A theme would be I'm going to invest in housing, which involves, and from a stock market perspective, which involves some companies that build houses and some companies that sell wood and some companies, you know, the whole thing. So yeah, I would call it not a thematic. The other part of the question is, or macro consideration I should think about. Yeah, I mean, listen, there's a couple different things you can think about with real estate. So generally in inflationary environments, real estate does pretty well, right? So we're talking about a REIT company that owns various pieces of real estate. It does well because number one, a lot of the companies do have within lease agreements with their clients, they do have automatic rent escalators based on inflation. So it's protecting them there. The other reason they do pretty well is generally, if there's a lot of inflation, it's going to cost a lot more to build a building. So we've got higher wages, we've got higher input costs, we have all this different things. So if I own a bunch of buildings, what does that mean? It means my standing building is actually worth more because it's going to cost somebody else a hell of a lot more to replace that. So I'm down in Barangaroo right now, and they're building a bunch of stuff over there by the Crown Hotel. But yeah, new projects, people are going to think twice about those if the labor and everything else and materials is going to cost so much more to build it. So to make that building more valuable. The worry, of course, is a lot of these companies do have a lot of debt. So the higher interest rates associated with trying to get inflation under control can be a problem. So it's important to look at the debt that those companies have. How is that? Where they do their financing? Is it fixed? Is it variable? What do they have to finance in the future? So I would look at that as well. And REITs have done pretty poorly over the past year or so. So could be an opportunity. How much percentage of unlisted funds you can put in asset allocation? So Angela is asking that just to minimize volatility. It depends what that unlisted fund is. So when you're saying an unlisted fund technically could be any fund, right? So any managed fund is a unlisted fund. So when we say listed, we're talking about stuff in the ASX. So maybe Angela, send me an email if you want to clarify that, just because those, of course, managed funds could be invested in all sorts of different asset classes, cash and bonds and equities, et cetera. Okay, so George says, how about a bit of speculation? 5-10% in energy. Not just oil and gas, but uranium too. I mean, George, listen, I think, what I would say is, this gets down to that investment strategy and approach you want to take. So a lot of people take the approach where they take more of a core and satellite approach, where they'll have a core portfolio that's, safe, passively managed, typically low cost, low taxes. And then they'll take, that satellite approach where they'll go out there and they'll try to basically beat the market, and they'll look at different opportunities. So, what I would do is, look at kind of your comfort level in doing that. And a lot of people do that, right? It's like going into a casino and be like, I'm not going to bring my, card to get money out of the ATM. I'll walk in with $100. I lose it. sunk cost, that's fine. So yeah, I think about sort of, what you're trying to achieve and the approach you're going to take. I don't think there's any problem in like dabbling in small amounts of your portfolio and stuff. It's just people that are making these widespread bets on things. All right, we've unfortunately hit the end of time period. I know there's some other things in the chat that I did not get to, so I apologize for that. But once again, you can send me an email, mark.lamonica1@morningstar.com. I'll try to get back to everybody on that. But thank you very much for joining the first of our webinars in 2023. I hope everyone had a great Christmas and New Year's, and I'll be back next week. So thank you.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.